I present the budget for 2023-2024.
So good evening, everyone, and welcome to Epsilon Money Masterclass session powered by JM Asset Management. In today's session, we will be decoding the recent union budget for you. And for doing so, we have with us Mr. Satish Ramanathan, who is a CIO Equity with JM Financial Asset Management. Satish has more than 3 decades of experience in the fund management industry, and he has been worked both on the buy as well as sell side of equity market. He has been associated with Sundaram AMC as a director equity, ICICI Securities, Franklin Templeton. So Mr. Satish is a CFA and has completed his MBA in finance from A&M University, Texas, and is an alumnus of IIT Madras. Along with him, we also have today Mr. Asif Bhatarkar, who is a senior fund manager equity with JM Asset Management, and Mr. Chaitanya Choksi, who is again a fund manager for equity from JM Asset Management. Without much of ado, sir, over to you, and we can start with your outlook on the budget. What do you read out of it, sir?
Yeah. Thank you all for joining us today. I know it's a Friday afternoon. I won't bore you with too many details. Thanks, Nitin. Thanks, everyone at Epsilon Money for having us on board. I think a key thing that we take away from this budget is the focus on efficiency, focus on CapEx and improving of infrastructure, and also in terms of reduction of subsidy and shifting away of money from revenue expenditure to CapEx. So 10 lakh crores CapEx by the government of India, big numbers, 33% increase is a big ask. Sometimes the government isn't capable of executing so much, but what we have seen in the past is that this government has been fairly efficient in doing so. The second key takeaway of the budget has been the fact that they've tried to give a little bit back to the middle class who have been impacted by inflation. I think inflation has cut in deep into consumption. We are seeing that take place in many of our consumer stocks as well. Whether it be pizza, whether it be groceries, whether it be movies, whatever it is, we have seen the cut inflation has made into household budgets. So they've tried to rationalize the tax structure. They've tried to give back a little bit to the middle class. Nothing meaningful. It may be a couple of thousand rupees per month, but still something better than nothing. So that's point 2. Point 3 is that, the government is fiscally conservative. We all know that it has been so for a long period of time. And it's reduced the fiscal deficit to 5.9% from 6.4%. Tax buoyancy will still continue. They have reduced the subsidies as well in fertilizer. They've reduced the food subsidy, and oil and gas subsidy is next to negligible. So those are the key takeaways from the budget. From our point of view, the government borrowings at 15.4 lakh crores is nothing much compared to the previous year of 14.21 lakh crores. So we don't think that the interest rates will tighten extraordinarily because of this. There may be other extraneous reasons such as a strong dollar or the dollar rates going up, which creates some tightness, but not due to government borrowings, definitely. And what we have highlighted is that the interest expenditure of 31% of revenue expenses is way too high. So if the government were to reduce debt or the interest cost by borrowing smartly and reducing the rates for itself by either having subsidized interest rates or tax-free interest rates for itself, then it's in a better position and it can release money for doing capex. So that's something which we need to bear in mind. So these are the key points of the budget. What I'll do is to take you across the next slide where we have prepared the total aspects of the budget. It's very briefly a lot of numbers, but key thing that I want to highlight is that the subsidies are coming down to about 1.75%, and food is coming down to 1.97% from 2.25 to 2.87. That's the key point. Then net government borrowing is 11.08, the as a percentage of the GDP, and not as a percentage of GDP, as absolute amount. You can see how the government has been able to reduce the borrowing cost, the 10-year GSEC yield, even if the money went up from the borrowing went up from 4,74,000 crores to 10,33,000 crores. So it's not that something that government needs to increase rates. If the borrowings increase, they can continue to reduce the rates, but what we expect is that there will be tightness in the money market, and to that extent you will see borrowing costs going up for corporates and SMEs and retail as well. In the next slide, which we want to highlight, is that if you look at the capex allocation, defense has received a slightly lower allocation as compared to last year. Then we also see that railways has got a huge thrust. Roads has come down to some extent, and we also have you see others taking 13%. But what is happening is that the government is focusing on a few targeted segments and growing it nicely. This year, for instance, telecom, it's a small portion, but telecom has got a huge thrust. So rural connectivity of internet and all of these things, digital library, all of these things are getting a thrust. The next is defense. The third is railways and roadways as well. So it's a very targeted allocation strategy, which means that there's something meaningful going to take place in each of these segments. And in the lower left hand corner, what we have done is we have plotted the actual growth rate of capex and revex, and you can see revenue expenditure has come down to almost 1%, even though subsidies have come down in the revex. But the actual thing is that 10 trillion rupees is going for capex, 35 trillion rupees is going for revex, and that they have frozen and improved the efficiency of the government and release this capital for capex. So that's one. And if you look at the YOY growth rate in borrowings, the key thing that I want to highlight here is that the borrowings are not going up too much, and the revenue estimates are reasonable. So it's almost all of these targets can be achieved, projections can be achieved. So this is something which I want you to take away from this slide. So in terms of the we have discussed most of this, but the key highlight that I want to make is that apart from the social improvement, this government has had a key strategy every year to improve the life of the underprivileged. So for 1 year it was LPG's gas, the next year it was water, third year it was sanitation. I mean, not in that order, and it's improving the health of the rural people. It's also empowering women to get out and work. So there is a lot of strategy in the capex that the government does, especially in the rural sector. ease of doing business has been enhanced. They're going to make PAN and Aadhaar interchangeable, and it can be used across the board for a number of approvals and transactions. So that's something which is a positive. But in terms of manufacturing, I think they have pretty much given what they can give in terms of the lowest tax rate of 15%. They have given a lot of PLI schemes, incentives, etc. So no further thrust for manufacturing. And then this is the sectoral aspect. If you look at the banks and NBFCs, I think there is a positive aspect for banks and NBFCs in terms of the credit guarantee for MSME, collateral-free loan available for up to 2 trillion rupees across the board for the MSME segment, and increase in outlay in PM Awas Yojana for housing, affordable housing. In terms of this insurance policy, I think, as you're all aware, the premium more than 5 lakhs will be taxed, no more exempt. So that's a mild negative. And, in terms of the new regime, tax regime, will have a slight impact on insurance policies, the incentives to take medical insurance or life insurance for that matter. So key thing is that infrastructure will get a good thrust. We think that power equipment, automobile, infrastructure, all of these will benefit from the budget. There are a lot of nitty-gritties which I don't want to bore you with, but these are the key things. In terms of defense outlay, it was a little disappointing at 7%. The reason what we came to understand is that there is a lot of unspent money in the defense budget, so they haven't increased it, and as and when the capex starts moving up, then they will release more capital. That's positive. Housing is doing reasonably well, and therefore cement is expected to do well. And so that's about it. I mean, if you have questions, I would love to encourage to have the questions first, and then we could probably go through further details. As you're aware, from the Indian market perspective, on a 1-year basis, Nifty has done well, better than, in fact, the mid cap and small cap. We are seeing small cap and mid cap facing a little bit of pressure compared to the large cap, primarily because of the liquidity issues that the country is facing, and investors shifting money from equity to fixed deposits and other debt instruments due to the higher yields. And as a consequence, mid caps and small caps have become a little more volatile than what we saw in 22. So that's something which I want to present before all of you, so that you are also aware that these are the key risks in the market that we are seeing. And we can probably take it forward. Globally, also, India's ranking on a 1-year basis has dropped. If you are aware, until November or September, October of 2022, we were the best performing index. And since then, Indian markets have corrected, whereas the US markets have done reasonably well. The NASDAQ has done very well this month. So we just need to bear this in mind. Nitin, if you want, we can probably start having the questions. Hello? Hello?
Yeah, Satish, we are able to hear you now.
Yeah, sorry. Is it better now?
Yeah, it's much better now, sir.
Yeah. No, can you tell me where you lost me? I mean, so that...
on a 1-year basis, the US market has done well now. We have dropped the table. That's where
Yeah. Yeah. So if you see, the Sensex is down 6.3%. Nifty, the mid cap is down 7.5, and BSE small cap is down 11.9% on a 1 year basis in dollar terms. So both the currency has depreciated as well as the markets have pulled back a little bit. So that's where we are.
Right.
So I think the basic thing is that even though volatility has come down, high beta stocks are continuing to underperform, and high quality stocks also are doing well, but high P stocks would kind of underperform because of the cost of capital going up. And if you see what is taking place, the GSEC in the upper left hand corner chart, the GSEC yield has stabilized and the PE of the markets have stabilized. The PE is now around 18 times and the GSEC is now about 7.4, 7.5. And we think that this would probably, if the GSEC yield were to drop, then there is scope for the market PE to expand a little bit. But that's broadly what we wanted to highlight. And key things that we want to, what are the issues facing the market? One, China open up trade and its impact on inflation, especially oil. Second, inflation, control of inflation. Two. Third is in terms of domestic flows into mutual funds. And fourth is FPI flows, which we think is still muted and negative, primarily because of the US Fed fund action going up. So people are still preferring dollar assets compared to emerging markets. And therefore, this is something which we need to bear in mind. From our market attractiveness has diminished over time relative to other developed economies.
Right. Right. Sir.
So that's about it. We can have questions now.
Yeah. Yeah. Thank you, sir. Thank you for providing us a brief snapshot of the budget and helping us decode it. We have few questions for you. Also, I would like to announce if anyone has any questions, please jot it on the chat and I'll take it up. So the first question is purely on the fiscal deficit side. As you rightly said, right? So the deficit has now been pegged at 5.9, which is a huge relief. Do you see any additional borrowing that may come up in the coming in the later part of the year because of the geopolitical things?
I think the key risk is, the crude oil prices and gas prices and our fertilizer subsidy. I think apart from that, we don't have much of a risk of us breaching the fiscal deficit.
Sorry, sir.
We don't have much risk of breaching the fiscal deficit because apart from the fertilizer and gas prices going up, if the prices hold, then we are pretty much okay in terms of the fiscal deficit computation, because the government has not exaggerated its revenues and it has not, it's everything else seems sober in terms of the projections.
Right. So one more thing, in the budget speech, we did not hear much about the disinvestment part. What's your take on that, sir?
I think the government is not focusing on that because it's a politically sensitive situation. So I don't think that they will go ahead with very much here. They have successfully reduced the valuation of every PSU, and to disinvest at this stage doesn't make sense for the government or the investor at this point in time. So probably we'll have to kind of handle this post the elections.
Yeah, so I'll just come in here. Actually, see, Nitin, this is a pre-election sort of a budget. This is actually
Right.
the last full budget, and it's because elections would be around the corner in about 1.5 years. Any disinvestment process would actually overlap the period, and it could become a political hot potato. So I think they have been wise there, not to promise what they cannot deliver. I think we can look back in satisfaction with the fact that Air India has been sort of disinvested in the previous year. It has been something which the governments successfully have not been able to do for last 15 years, and government after government has taken big hits on the fiscal because of that particular asset. So although the amount that has been raised from that asset may not be significant, the potential risk to the finances in terms of the hit on oil, etc., or the losses, employee pensions, etc., that's been sort of taken out. I guess we need to be just satisfied with what has happened. Nothing more this year.
Sorry, Asit, I'm not able to hear you, or maybe we missed even between because of poor connection, I guess.
Where could you hear me?
No, I think what Asit wanted to say is that broadly, the pre-election year, we wouldn't have too much of a thrust on these politically sensitive disinvestments. The only satisfying thing is that Air India went through peacefully and it's done well, and the Tatas have turned it around. So that's where we are right now.
Okay. So just one question on this. Every fund house would have some kind of expectation from the budget, and then the budget is announced, right? You would also have some kind of expectation from the budget. If you see on the hindsight right now, what do you think is some kind of expectation that you would have which is not met by the budget? What would that be?
I think the expectations which we had is that actually to give back a little bit of the benefit of efficiency in tax collection back in simplifying the GST rates, one, and probably reducing income tax slabs and rates also to, kind of in an inflationary environment where savings has come down, to release capital back in the hands of the consumer to prop up consumption. I think that was a little disappointing for us because inflation has really impacted the household budgets. That's one part. And GST, the government giving the elasticity in collections of GST, they could have well reduced the GST by a percentage or two, and kind of help the economy revive and sustain its growth trajectory. And one thing that we need to bear in mind is that several sectors are still to cross their pre-COVID levels, while some have. A lot of sectors have crossed their pre-COVID levels, but still it's not uniform across the board.
Right. Right.
So which means that even though the GDP numbers may come out at 5 or 6%, which is on back of services, our actual GDP has been below capacity or below subpar for almost 3 to 4 years from or in at a stretch, because first we had GST and then we had COVID and then we had I mean, it's been a non-stop kind of changing the goalpost, if you will, from demon times. And that's where I think we are a little disappointed. Asit, if you have anything you can add.
Yeah, I think that is the thing. I think we would have definitely liked to see a more emphasis on savings, because a growing country needs to have a better savings rate. And especially with the data that we've been seeing over the last few quarters, where the saving rate has been dropping quite dramatically. So I hope, for our sake, that the COVID effect is over and rural India really takes off in this year, and this gets addressed. But I think not much has been done in the budget towards that. So let's see. I think the fact also is that a lot of data is sort of skewed because of COVID, and we may not be able to see the full picture. But from where we are standing, I think more could have been done to simplify governance, more could have been done to encourage savings. Thanks, Nitin. I'm done.
Asad, are you able to hear me?
Yes, I am.
Yeah, sorry, I missed you in between because of the poor connection.
Oh.
So not an issue. So since we are in this, we are talking about savings. This budget has too many things to cheer up the common man, right? There were tax rates reduction that was announced, and all. How do you think this should fare up? Do you think there would be too much of discretionary spending going up, do you think that will help your savings side of it? People would have more income, so they will save more. What's your view on that?
I don't know actually. The verdict is going to be out on this later. Okay. This is actually, typically, what I would think is that, where you encourage saving is actually in the lower income categories, right? Because they will be encouraged to go to the new regime. And when incomes are lower, and you incentivize them to spend rather than save. See, earlier we would save because we had to take that deduction and take that rebate. I'm saying don't do anything, just go and spend. uh, I don't know how things will be. Most people will not be proactive enough to save, is my guess. But I could be reading India wrong. I don't know how the youngsters these days think, but my guess is that this is not incentivizing savings.
The one more thing that government is also trying to do is trying to make the domestic people invest into the domestic market rather than sending money abroad. Because if you see the hike in the LRS TDS, what they have done, the TCS basically, which was 5%, now they have done it to 20%. So do you think they would want people to invest in India, and they would and avoid your offshore investments?
Yeah, actually, in fact, that you brought me to the another disappointing part of the budget, right? You cannot force people through taxation. I understand incentivizing and disincentivizing, but I think if your assets are attractive, they give you more return. That is enough. You don't have to use the power of tax to disincentivize investing outside. If we are to believe that India is the next emerging thing on the global scene, our growth rates are going to be significantly better. I guess our investors will not only be investing here, but foreign investors should also come and invest here, right? Uh, so this is sort of a confusing signal to my mind. Yeah, there may be other compulsions that are there in terms of tax leakages, etc., which may be which may be influencing this whole thing. But overall, I don't think it sends the right message.
Right, right. So now, if we move to the on the equity side of it, and of what we have heard on your view, on your sector view on equity, what are the changes that you plan to implement in your portfolios with budget being behind us now?
See, actually, that's a little bit of a forward-looking question, but I'll try to answer it differently. See, budgets have come and gone. They have big news on that day, and the lasting impact is only the tax actually.
Hmm.
Policies made throughout the year, and in fact now biggest part, which is the indirect tax, is actually out of it.
Hmm.
So, in the long run, in fact, a few weeks from here, the budget may not have any impact on our lives or on the capital market, but it does give a direction to how the government is looking and which sector should be encouraged in the long run. It does not have any immediate impact, right? For example, if they have not spent as much on defense this year, does that mean that defense companies' results will be bad? They won't be. It actually will have no impact, because you don't know what is the capital expenditure, how the revenue expenditure, that part is going to behave. Secondly, allocations made in last year for orders made last year will be anyway executed this year. So the reported numbers is what the companies will do well on, right? Similarly, what probably they have done, one of the sectors we had mentioned where insurance, there is a negative. To how big a negative it is going to be for the next quarter, I don't think it will be a big negative for the next quarter. Stocks have reacted, so there will be some opportunities. And see, our basic idea is that we have a philosophy of identifying stocks on the basis of what kind of returns they are going to generate, what kind of return on equity they have, and the other financial metrics that are existing, which we generally prefer debt averse companies and high ROE companies, etc. We stick to that. These are events which come and go, but our basic philosophy of investing sort of remains the same. So we don't think it will dramatically change anything in what we are seeing. We have positioned our portfolios to face the headwinds that are in front of us, and to our mind, the biggest headwind in front of us has been the high inflation last year and the interest rates which have gone up, globally. And towards the end of the year, the bigger other big challenges become is that our market didn't correct, and globally all markets corrected. So relatively, we stopped looking attractive.
Right.
And that is in the process of correction right now, because some of the other markets have become just too cheap, and
Right.
we looked a little expensive. I think that gap has been bridged. Our portfolio is created for that. So, we don't see much changes in our portfolio, considering that.
Yeah.
In fact, most of the changes that we are seeing have already been made. Chaitanya, please continue.
Yeah, just to add to what Asit is saying, so we have a well-defined philosophy of stock selection. We call it our geek model, wherein we have a lot of parameters based on which we select stocks, and there is a strict filtering process in terms of management quality, earnings growth, and return ratios, capital efficiency. So a lot of things matter in the way we construct our portfolios, along with that quality of management. And end of the day, the right sector selection and stock selection is what delivers alpha and returns over the longer term. And we have followed this approach in a disciplined manner, and that has helped us in delivering consistent returns across our portfolios over longer periods of time.
Right.
I'm just flashing
Yeah.
the geek model that Chaitanya referred to.
Thank you. But Chaitanya, one question to you.
Yeah.
Basically, with budget budget is behind us, right? So now, where will the focus shift? Will the focus will shift back to earnings and global cues? And we also have the MPC meet scheduled next week. So, do you see any negative surprises coming out of that?
So I don't think there is, as you said, budget is out of the way, and eventually, I think what matters is earnings, as you rightly said. But in terms of events which are coming up, globally as well as for us, is how this inflation trajectory pans out, right? So we have a feeling that inflation has more or less peaked out, and it will reverse from here. But we don't know how energy prices will behave due to whatever reason. If crude goes back to say above $100 a barrel, So commodities have been coming off, but that is still a question mark according to us. It's not as if we know for sure that inflation will keep coming down, and the interest rate hikes that we have seen globally, they will see a pause, and there will be a reversal. This higher rates for longer.
Right.
That is, by when we can see that reversal, in a consistent manner rather than, undecided sort of thing. So that can change, way flows come in, how markets behave, how, that will impact macroeconomic factors. So that is what we need to watch out for. Apart from the usual risks, and most of the time we've seen, the risk is actually from the unknown.
Right. Right.
Or something which hits us like COVID, who would have
Yeah.
anticipated,
Who would have anticipated? That's right.
exactly, or
Yeah.
something like, some corporate group having problems, who would know when
Yeah.
it will come up? So
So,
that is what.
but yeah, I think it's safe to assume, just to add to what Chetan has said, is that bulk of our inflation problems are behind us. Suppose our problems were 100, probably we are more than 80%, through that. I think bulk of the interest rate hikes are also behind us. It shows in the way debt markets are trading, how
Right.
how the rates in the market have behaved over the last 3-4 hikes that RBI have done. So a market is sort of expecting this, unless there is something unknown. What we have to see is clearly, when will the central banks have the courage to pull the interest rates down. Now there is a little bit of a question mark there, because last year same time, this quarter, we had this Ukraine war starting. So incredibly inflation will look low because of the base effect, but that does not mean that it's really low. It's
Right.
the base, and once the base wears off after 6 months, we have to really see how the whole inflation thing looks out. Also, we are expecting, globally there is an expectation of a mild recession. Uh, you know, what if it becomes a very sticky
I was coming
recession,
to that.
or else
Yeah.
vice versa? What if there is no recession? Growth just beats the estimates, and central banks have to do more. So I think everybody, including the central banks, are sort of today awaiting data and more clarity before they proceed. But I would think on inflation and interest rate, bulk of our problems are behind us. The impact of that is being seen on P&L of companies, and that is what we are trying to gauge and avoid. So wherever there is the interest rates have gone up and it affected consumption, then those companies are getting hurt. Wherever the interest rate, wherever the inflation has started coming down, the producers may be suffering and the consumers may be benefiting. So we are looking at those opportunities and those plays within our portfolio.
Right. Right. So in the interest of time, just last two questions which has come up was one, obviously on the obviously from a retail investor standpoint, we are listening about recession, we are listening about various things, right? Inflation, rate hikes, rate growth is a concern. Where does the investor, if you want to create a portfolio, what should be an ideal portfolio from an asset allocation perspective? Because we have been hearing from various houses, right? This is a year of asset allocation. So what's your view on that?
This is a damn good question, Nitin, but I'll just correct you there. Every year is a year of asset allocation.
I just need a disciplined approach to that. That's
exactly.
what matters.
So I understand, there are some years where debt may not be doing well, but this year exactly shows you why you should have been having debt. And there may be a period sometime now where you think equity is not really great, and PPF and FDs were the thing to do, because you will suddenly see the 10-year PPF as the best performing return or something. You'll see that on the newspaper. But the fact is, these are cycles, and what happens when any skewed market where debt does extremely well, equity does extremely well, your asset allocation moves, and you have to constantly look at that. And Nitin, I'll tell you, that is the job of a financial planner. Equity fund manager is always biased towards equity, so we are the long people to ask.
That's right. So I don't have any further questions. And in the interest of time, I think it was nice chatting with you, both Asita and Chaitanya. And you have given us a very in-depth view about budget, as well as where do you see the markets from here, and what's how your portfolios have also been positioned for that. I would like to thank you both for having taking out time and having a chat with us on a Friday evening. And wish you a very happy year ahead and happy weekend ahead also.
Hey,
Thanks a lot, Nitin.
thank
Thanks a
you.
lot
Thank
for
you.
having
Thanks
us.
everybody on this call.
And yeah, bye.
Wish you all great health and wealth. Bye.
Thank you. Bye-bye.
Bye.